Hi, everybody. So it's been great because anyone who joined us a few minutes ago got to hear a bit of chitter chatter, got to hear about Tim Pup and stuff like that. See, it's a casual conversation. I'd like to welcome everyone to our conversation today, our webinar on green investing, how to begin. And thanks everyone for tuning in. My name is Vicki Stroich, and I'm Partner and Community Engagement Director at Alberta EcoTrust, and I'm going to be your host today. Alberta EcoTrust is an organization with a mission to partner across boundaries to mobilize and inspire those who champion and protect the environment. So that's why we're really happy to be partnering with our friends at the impact investing firm CoPower to produce this webinar and empower and mobilize individuals to champion the environment through their investments. Now, before we start, I just wanted to start with a bit of housekeeping. The webinar is going to be about an hour long. I'm going to be asking the panelists some questions for about 35 or 40 minutes, and then we're going to answer some questions from you. So also just a friendly reminder, you are going to receive a recording of this. So if you find yourself madly trying to write down everything that everyone's saying, don't worry, it's going to come to you. You can just sit back and relax and listen. And before I introduce the panelists, I want to just introduce and invite CoPower's Greg Overmans to say a quick hello. Greg?
Hey everybody, my name is Greg, and I've been working with Vicki to coordinate this event, and I will be just over there on the chat. I just said welcome to everybody, so feel free throughout the process of this presentation, write questions, let us know what's on your mind, and I'll make sure to float it to the panel once we get to that moment in the presentation, but otherwise, I'll be over on the chat.
Thanks, Greg. Greg's also going to be putting together a little list of resources that's going to go out as well afterwards, so websites and things like that. So again, if you were like, what? I didn't quite catch that. Don't worry, we're going to send it to you. So thank you so much, Greg, for doing that. Now, I finally get to introduce our amazing panelists. With me here in Calgary is Patty Dolan. Patty is Portfolio Manager with Mission Wealth Advisors, a part of Raymond James Limited, and she's based here in Calgary. Patty's been in the investment industry for over 30 years, and she's practiced responsible investing since 1995. She also currently sits on the National Board of Directors for the Responsible Investment Association, among many other amazing achievements. So welcome, Patty. Thank you. At CoPower's office in Toronto is Tim Nash and Trish Nixon. Tim is a financial planner and economics instructor at Sheridan College in Mississauga. He's also the founder of Good Investing and the blog The Sustainable Economist. And he's a lead researcher for Ethical Markets Green Transition Scoreboard Research Report, which details more than $2 trillion of private investments in the global green economy, among many other amazing achievements. So welcome, Tim. And Trish is Managing Director and Head of Capital at CoPower. So she leads product development foundations for the company. In her prior roles at Mars Discovery District, she provided advisory services to investors and intermediaries, founded a social venture accelerator, and led venture services for the SVX investment platform. Trish is also the 2016 recipient of the Edward Newton Award for Social Innovation, and a co-recipient of the 2017 Clean 50 Award for Environmental Entrepreneurship, among many other amazing achievements. So it was really difficult, I'll say, to narrow down and highlight just a few things from everyone's bio. So welcome to all of you, and thank you again for exploring all of this with us. So full disclosure, my desire to host the webinar is selfish. I've been thinking a lot lately about the environmental impacts of and social impacts of a lot of the decisions I make and that I have the privilege to make. And as proud as I am about eating less bacon and stuff, I think I'm starting to realize there's a lot more significant decisions that I make that I'd like to learn more about how to consider those through the lens of a positive impact on the environment. And I don't know a lot, to be perfectly honest. I have an RSP and a TFSA at a bank. I haven't asked a lot of questions about where they're invested and what my options are, and I need to know how to begin. So I figured there were a few folks like me out there. Maybe the people who are watching today can relate to some of that. So thanks again. This is going to be really valuable for me, and I hope everyone else too. And to start, I'd love to hear a bit about all of your journeys. So my first question for each of you is, how did you discover a passion for green and responsible investing? And why do you do what you do? I don't know, Tim, do you want to start?
Sure. So I'm pretty lucky in that I found my passion very early in my life. It was more than 10 years ago. And it was a combination of being really frustrated by the economic models that I was being taught. I always realized there was something missing from them. And then the opportunity to travel really allowed me to have a really deep connection with nature. And when I really realized that that our economic system was completely ignoring human capital, social capital, natural capital, and was really participating in really, I would say, the exploitation and destruction of a lot of those forms of capital, that's when something clicked inside me saying, okay, I knew that I needed to really be a part of that. From there, I graduated from school straight into the financial crisis. So I finished my master's degree about 3 months before the markets crashed. And so great timing to find a job. So I ended up starting my business. That's what kind of led me down the entrepreneurial path. And really from there, it's just been this process of trial and error, listening to the market, understanding what people need, and really kind of following that. And what I found is that so many people like yourself are really stuck when it comes to their investments, where they don't really know where to start. There's not a huge amount of investment literacy that's being taught in our schools. So people really had a lot of questions when it came to this. And by answering those questions one at a time, I really kind of built up this practice. And I would say what really keeps me going, what motivates me is two things. Number one is just simply helping people. I love just helping people overcome these obstacles and sort of figure this out. And number two is realizing that I think we are a little bit ahead of the curve here, that it's so clear to me that the economy is shifting in a sustainable direction, and that the stock market is absolutely going to start to pricing in these sort of social and environmental issues. We can talk about some specific companies in the news lately in the last week or so that have kind of seen their share prices hit due to a lot of these risks. And so for me, it's there, I kind of get a kick out of being ahead of the curve, being a bit of a leader there, and hoping to help people invest ahead of the curve such that they can make a lot of money with this.
Trish, what are you?
Sure. Yeah, so I grew up in a family full of investment bankers, and like Tim, I think over the course of my education and being exposed to various concepts and history and looking at the world, was pretty frustrated and disenchanted with some of the negative consequences of our capitalist society in terms of equality and environmental degradation and whatnot. And so I wanted to go in sort of the complete other direction of I guess my family, good people, but, I wanted to choose a different career path. And, in doing so, I studied international relations. I was really fascinated with policy decisions and very active in volunteering, and then ultimately career-wise too in the philanthropic sector. And as I was sort of early in my career, figuring out what direction I really wanted to pursue, I kind of came across this nugget of the concept of social finance or impact investing, which sort of took business and capitalism and investing and thought about it in a different way through a lens of social environmental impact. A light bulb for me kind of went off, and I was like, well, this is what I want to do. Rather than kind of go do something completely different than my upbringing, I guess. How do I be a part of making capitalism work for society? And so from there on in, you heard a little bit of a bio, but I started working at Mars Discovery District in their Center for Impact Investing, doing a lot of capacity building, supporting investors, new funds and products, startup companies to either invest or build companies that had positive social environmental impact and strong financial returns. And that's my career has been really heavily focused on accelerating impact investing in Canada. And while I was at Mars, that the founder of CoPower and very conceptual at that time, But there was a startup company that was on a mission to help finance the low carbon transition by investing in infrastructure, which is, from a risk return perspective, a neat opportunity to have investments that make sense for a broad base of investors, and to make those types of investments accessible to a much broader base of investors. So while I was at Mars, I couldn't really practice what I preached. There weren't a lot of impact investment products, and happy to get into a little bit more of what that meant, that were actually available to me. And so CoPower was founded on the concept of there's demand for financing to accelerate our low carbon transition from project developers, et cetera. There's demand from investors to participate in those types of investors, and growing awareness, growing demand. And how can we marry the two? And can we use technology to reach a broader base of investors, allow Canadians, to invest in clean energy from their kitchen table, and kind of bypass the investment systems that I guess that were shutting out people like me who wanted to invest with my values. And so we're a piece of the sustainable investing umbrella. But that was really an exciting opportunity for me to kind of jump over and really build that kind of from the ground up. And here I am today.
Awesome, thanks. Patty, what about you? What brought you to the work?
Well, I had to laugh when Tim said, "08, you went into the industry." 1987, I wrote my securities course. I graduated into the first correction of the market. So I started my practice in 94, and about 95, by a professor at the University of Calgary in the Haskayne department, and she wanted to know more about a index that was being put together by Dow Jones, and it was called the Sustainability Index. Well, number one, I had never really heard of the word sustainability, and she kind of described what it was about, and so I was a bit skeptical, and I did some research into it. And out of all of the global companies, only 10 were accepted into the first version of the index, and 3 of those companies were from Calgary. So that really piqued my interest. And those 3 companies were Suncor, TransAlta, and TransCanada. And so the least likely suspects, I figured, that would have made it into an index. So from there, I started, looking at my investments just a bit differently. How did they treat the community? How did they treat the environment? How did they govern themselves? So the 3 pillars of responsible investing. And from there, it's just progressed. When I first started reading the sustainability reports, there really weren't any. It was usually a president's letter, and there was a comment about buying hockey jerseys for the local team, or some such thing. It was more of a feel-good approach. And now it's become incredibly scientific and very in-depth. So I'm excited about the progress, and I'm really excited about the impact investment side of the business also.
That's great. Thanks. Thanks for sharing, everybody. Now, I also imagine that you probably all get a lot of questions from clients and family and friends or casual acquaintances like myself about what should I do with my money? So I guess I'm curious about what do you find is the most common question you tend to get, and how do you tend to answer it?
Sure, you want me to start?
Yeah.
So it's tough. I get a lot of basic ones. One of the first ones I always get is, how much do I need to start? That I think there are a lot of people that come to me that only have, $3,000, $5,000. But I mean, I've had some people with like $30,000 or $40,000 that don't think that's enough to get started in the investment industry. But really, that's the question that I always get is sort of how soon can I start investing, especially from the younger crowd. And so for me, it's pretty straightforward that, people can get started, with probably as little as, 1,000 would be the bare minimum, to have a portfolio that's about $5,000. That's when you can start to take a bit of risk. And then from there, your options really only increase. So you're a little bit limited in your options until you probably hit about 15,000. And then from there, the options really start to open up. And then obviously, as you sort of climb the bucket and, get into the hundreds of thousands and millions of dollars, that's when really the investment world is your oyster, that you can do absolutely anything. But really it's about, this idea of how much do I need to get started? And I would say for as little as, sort of 3 to 5K, people can start investing for the long term.
Yeah, and I think, obviously in my role, I get a lot of specific questions about CoPower and the types of projects we finance and, the features of our products. But I'll do a little bit more, aside and in addition to that, a little bit on a broader level. I often get the question of, we at CoPower very often get the question of what other green or sustainable or impact investments are out there. Those are people who have sort of already found us, who are obviously kind of seeking these types of opportunities. And there's certainly lots of, I wish there were more opportunities, but there are lots of great opportunities out there that we direct clients to, and we'll obviously share some of those resources. And then, aside from that, if we take a step back and, people are hearing about what I do or about impact investing, a lot of it is just, how do I get started? And, I think my answer to that is there's two approaches. Either, think broadly, you can think about your investment portfolio and what are you invested in and how can you improve each part of your asset class, when you're thinking about your public equities, or do you have room for alternatives like a green bond or fixed income, and do it in a very thoughtful, planned out approach. If you're going to go that way, Tim's a great resource. So we definitely send a lot of people his way. And there's other Patty in terms of an investment advisor, and the RIA website's a great place to go to understand who else is there that can help you with that thorough approach. The other way is just start. Find a product that you like. Take a step. Look, are you interested in a community bond or a green bond? Are you on a platform where there's a sustainable ETF that might be better than the other ETF option? And just sort of start to take little steps and see how it goes. And don't let a fear of not knowing all the answers prevent you from taking a step.
That's great. Thank you. There's a couple of acronyms that came up there that I just want to ask about, because some people may already know, but I'm just going to ask. So RIA means Responsible Investment Advisor, right?
Association.
Yeah. The organization that Patty's on the board of.
Yes. Awesome. And then ETF means?
Exchange Traded Fund.
Exchange Traded Fund. All right. Thanks, everybody. Just making sure we're all speaking the same language. Patty, what about you? What do you tend to get asked first?
What is responsible investing? Period. And there's a number of different versions of responsible investing. There's a lot of terminology around it. There's ethical investing, green investing, impact, whatever. But there's lots of different ways or approaches that you can take to responsible investing. One is shareholder engagement. You can invest thematically. You can invest in, let's say, a water exchange traded fund or ETF. You can choose to divest from investments. So you can choose to not have certain sectors, like certain types of companies. So let's say a company that makes weapons. You don't want that in your portfolio. You can ask for that to be excluded. So there's a number of different ways to obtain responsible investing. So it's a very broad term, but you can be very specific and dial into exactly what you want to align your values and your investments.
Thank you. Now, those are the questions that are asked most commonly. My next question is, what question do you wish more people asked? Like, what do people sometimes miss? And what do you wish people asked more often?
Sure. So for me, the biggest myth when people come to me and start having these questions is they automatically assume that responsible investments have a lower financial performance. And right off the bat, it's really funny. I get people saying, well, money's important to me and I want to do well, but, I'm really very ethical. And so it's more important to do these right decisions, assuming there's a trade-off there, when the reality is that responsible investments have done just as well, if not a little bit better than traditional investments over the last, and it depends on the time horizon, but I feel very confident that over the last 5 or 10 years, they've done sort of just as well. Here in Canada, they certainly have done better. And that really it's about understanding, again, where the economy is headed. that if we accept that, young consumers and workers, the best employees coming out of business school want to support companies that are leaders in this way, if we assume that there will be continued government regulations around and movement towards those sustainable development goals, then really, right, already they're doing just as well. If we look at the next 10 years, 20 years, 30 years, 40 years, to me, it's undeniable that these companies are going to continue to do just as well, if not better financially. So I really really wish people would come and ask me, why do responsible investments outperform? Because I think that, there's a really interesting story there. But unfortunately, so many people come to me with the expectation that they're somehow going to do worse, they're going to have to sacrifice returns, when that just is not the case at all.
Yeah, absolutely. I mean, I think that's a preconceived notion that, I hear a lot too. And, maybe to preempt my answer, I should explain a little bit about CoPower and what we do and what our products are, which is, so we're a private investor. We invest in clean energy and energy efficiency real assets. So these are projects that generate clean power, reduce energy consumption, and then we raise bonds and funds to finance these projects. And so if you buy a CoPower green bond, you're buying 6-year, 5% fixed return bond that's an alternative investment. It's a private investment, and it doesn't it doesn't fluctuate with the public markets. So it's unique in that respect. It's different than buying a bond from RBC. So I think one of the things that I hear a lot is, 5%, but I made 7% in my equities portfolio last year. So why would I do that? And that's kind of interesting because it doesn't actually pertain. I think it's linked to the concept of sustainable or impact investing has lower returns, but it's also just a general kind of investing concept. And again, Tim and Patty are better than me to speak to this, but I think when you are looking at that is true. You can invest in all public equities, and on an up year, you can for sure do better than a 5% green bond. But then if you look at this past year, most people ended up netting equal or below where they started. So there's volatility associated with public markets that means you're probably not going to always have that high return trajectory. And so I think that as people start to educate themselves more around investing in general, they start to understand what a balanced portfolio looks like, and the fact that having an alternative investment that isn't correlated to public markets, that has a steady fixed yield, is a really nice diversifier and a really nice piece of your portfolio to complement some of your other investments. And so I think that's something that I hear a lot. And we talk a lot about diversification in terms of one of the benefits of CoPower bonds. And again, I think Tim and Patty, who kind of construct portfolios more broadly than I do, probably can speak to this better. But that's something that I hear a lot of.
And before we get Patty's question, Tim. What
Sure.
that was, what's
Sure.
traditional investment?
So really what we do when it comes to investing is we always need to have a benchmark. And so the traditional benchmarks in Canada, and again, this speaks to Trisha's point that you want to make sure you're sort of trying to compare apples to apples. So the traditional benchmark here in Canada would be the TSX 60, which are the 60 largest companies on the Toronto Stock Exchange. And there's no sustainability, there's nothing there. They just get the top 60 companies. So obviously there would be a lot of banks in there. There would be quite a bit of energy and pipelines and mining, just because that's the Canadian stock market. What I'm referring to would be a socially responsible investment like the Jantzi Social Index, which is really, I would say, the benchmark for responsible investments here in Canada, which is very similar to the TSX 60, except they remove sort of the worst companies. So, so really what I'm saying here is that a traditional investment portfolio, I would assume, would be invested in those sort of very traditional benchmark index products. And these could be mutual funds, they could be ETFs, but when you look at it, a lot of them are very, very similar. So that's what I would consider to be a traditional investment. And then a responsible investment would be something that very specifically, usually they omit what we call the sin stocks. Responsible investing, to my understanding, and Patty, please correct me if I'm wrong, but was really created for the Mennonite community here in Canada. And so a lot of the traditional religious sort of sin sectors were omitted, like tobacco, alcohol, weapons. I know nuclear was part of that. And then also getting rid of companies that either have very low sustainability scores. So they do this analysis, and if they're found to have very, very poor scores there, or if they're embedded in a major controversy. So for example, SNC-Lavalin, which has been very much in the news lately, and which has taken a really big hit in terms of their share price over the past little while, that would be included in the traditional TSX 60 index. However, it is excluded from the Jantzi Social Index. So basically, if you were in the Jantzi Social Index, you would not have had that exposure, which obviously there are ethical implications there, but also very real financial ones, which is one of the reasons why, the performance has been a little bit better. Does that help?
Awesome. Thank you very much. Patty, do you want to speak to responsible investing or things that you wish people asked or wish people knew a bit more about?
Sure. Well, very similar to what Tim was saying about, the misconception that you're going to lose if you invest this way or you're going to miss out on higher returns. And there's been a couple of studies, and as Tim was talking about the Jantzi Index, and I think we're going to have links at the end of this presentation. And
Yeah.
I do have the link to the performance indicators to the Jantzi Index. And so for an example, last year they did quite well compared to the Canadian markets in general because they had less exposure to the oil and gas sector, higher to the financials. So, there's the pros and cons in how that's allocated. But there's been another study too out of Carleton University that shows that there's less volatility in mutual funds that use this process of screening with environmental, societal, and governance. So I think, what happens is companies are being proactive. They're looking at, how to run their business. The business isn't just, make money and that's it. They actually look at their impact in the community, on the environment, and also how they govern themselves. So they're a lot more transparent, and they've done a lot of thinking and built in the ESG strategies into their everyday business activities. So,
this may have already been explained, but ESG means
environment, societal, and governance.
environment,
Three
societal, and
pillars,
governance. Awesome. Thank you. The CRA investment deadline's coming up in about 2 weeks, March 1st. So I know that a lot of Canadians are thinking about their investments right now. So I guess, and I'll start with you, Patty, maybe. What advice do you have for people who are really thinking about this and are thinking about that deadline to start? What can they do today or tomorrow to start along this path?
Well, number one is to realize that it's two separate issues. Making the contribution is physically getting the money into the RSP account, and there's a deadline on that. The second transaction is making an investment decision, and that's totally separate. There's no deadline. You can put the money into money market or just leave it in cash and then make your investment decision when you're comfortable about that decision. So I really would suggest to the audience to take your time, do some due diligence, interview investment advisors, make sure that you're investing in the proper investment that really sits well with you and not your advisor necessarily, because sometimes there's campaigns to push certain products, and so you really want to make sure that you're doing what you feel comfortable in, and do some tire kicking. Ask the hard questions.
Great. What's an example of a hard question?
How much is this going to cost me? Right? That's
Yes.
like, what are the fees?
Right. That's a good one.
Pretty simple.
That's a good one. I'm writing that down.
One other question that if you do have an investment advisor that, for those listening, that I always like to encourage people, whether or not they have expertise or are interested, they may be totally against the concept of responsible investing because they have some preconceived notions that may or may not be accurate, ask them and push them and make them look into it, make them tell you about the different ESG factors or the different products that are available to them to purchase to you. I think that, in terms of creating more socially responsible or impact investing products, getting a bigger wave of investors thinking like this and advisors thinking like this, it's going to come from the client. It's going to come from you and your values. And I think I've seen for sure in the last number of years, again, CoPower has, we often, investors invest with us directly, but more and more and more, advisors from the big banks, et cetera, are calling us all the time saying, how do we get our product on your shelf? We have so much client demand for, this type of product. And as that wave continues, our financial services industry, it's just going to absolutely change, but it needs to come from you. So poke your advisor, ask that hard question.
Patty had something to add here.
Yeah, Trish, that's an excellent point. And what I've always suggested, if somebody has a good relationship with their advisor, but the advisor doesn't understand this concept, I am more than willing to talk to them, because I think the more advisors that are willing to take this on as part of their practice, the more products that are going to be available, and the better it is for all of us. So we call it co-opetition, and I think Michael Jancy had actually coined that phrase.
Yeah.
So
Great co-opetition.
co-opetition.
Tim, what do you think people should be? What do they need to do to start, or what questions do you think they should ask?
So thank you. The awkward question that I really love people asking is, what's actually inside my portfolio? Because oftentimes people have no clue what's in there, and especially when it comes to mutual funds, which is still about 80% of Canadians own mutual funds. You often get these layers of onions, right? So you own like a balanced fund, and what's in there? Well, we have this fund and this fund and this fund. Well, okay, well, what's in those, right? And then often the legal requirements is they only have to tell you the top 10 holdings. And you can get that information. It's there, I know, right? You can get the information, but it's a little awkward, requires a little bit of digging, right? You can get a list in these snapshots. They have to file the full list twice a year. But really, most advisors, will sort of push back against that a little bit. And if they're not transparent about what's inside the portfolio, that can be a bit of a red flag. And really at the end of the day, see that list of companies and understand that if there are red flags in there, that you do have other options. And I think to Patty's point, I really love that sort of learning approach. And what I find is that if people have an advisor that is willing to work with them and it is willing to learn with them, then, oh my God, that is a fantastic relationship and something you can have. That said, I've heard a lot of horror stories from clients who have brought up these issues and get mocked and get laughed at and get derided. And I had a client who, her advisor made her cry by telling her that she was, stupid and she was throwing away her money and, how dare you do this? And, I really love reminding people that it's your money. So if your advisor, if your professional is not willing to work with you, find another advisor. And there are some amazing people like Patty that would, I'm sure, love to help you and provide better service. At the same time, there are some amazing options that are out there for do-it-yourself investors and for all different types. So, this is something where I find people often get sort of stuck in the status quo. So I think the first question is always to ask those tough questions, but then see how your advisor responds.
And by the way, advisors who were sort of scoffing or not interested or not willing to do the work on this sort of stuff 5 years ago are now knocking at the doors of people like us saying, wait, so, you mentioned that thing called impact investing. I'm getting a lot of client questions. Can you tell me more? Yeah. And all of a sudden they're perking up. So if you get that response from your advisor, chances are 5 years from now, they're going to be like, man, why didn't I listen to my client when I had the opportunity to be, more on the leading edge here?
That's right.
Yeah, it's great to think about about feeling empowered and feeling, this is part of what this is about, feeling empowered to ask the questions and really find out and find the right relationship. I think that's really key. A lot of people often feel like they're stuck with the wrong physician or the wrong, and this is no different. So thank you all very much for that. I think We're probably going to turn to some audience questions. I don't know, Greg, what have you got for us? What are people asking about?
Yeah, so there's some good questions here. Allison asks, I find it easy to find bonds, but I'm a young investor who is looking to invest very long term and would prefer a bit riskier green investments. Where should I start looking, or where could I look for that?
Sure, I've got ideas, and so really the approach that I sort of advocate for is for people to learn how to do it themselves, especially if you're just starting out. It can be a great sort of valuable skill to learn, and it really does open up the door. So really, to start this conversation off, I think people need to understand the difference between mutual funds and exchange traded funds, ETFs. Both of them are very suitable, and both of them have some sort of higher risk, specifically green investments, what Patty referred to earlier, sort of like thematic investments. And in this case, the theme would be sustainability or green. And with ETFs, exchange traded funds, you can get hyper specific. So there are water ETFs or renewable energy ETFs. There's an organic food ETF. There's now an ETF linked to the UN Sustainable Development Goals. So there's some really, really cool ETFs on the market. It does require a little bit of expertise. You've got to know how to sort of set up the online broker, go in, make the trades yourself, which isn't that hard, but it definitely seems scary the first time you do it. And then from there, probably the easier option, but it is more expensive on the fee side, would be to look at mutual funds. So, NEI, which is Northwest Ethical Investments, has a great environmental leaders fund. AGF has a sustainability fund, and I believe Mackenzie just partnered with Greenchip Financial, and they're now offering this global environmental equity fund. So really, that would sort of be the fork in the road, where either you could look at mutual funds, which might be a little bit easier. Everything would be in Canadian dollars, but the fees are a little bit higher on those. But certainly those would be sort of broader funds. Whereas, if you're open to it, you could take the path of opening up an online broker or working with an advisor that lets you buy ETFs. And then that allows you to be sort of hyper specific in terms of looking at those different sort of thematic sort of impact ETFs that would have that higher risk, higher return profile that I believe it was Allison would be looking for.
Yeah, and maybe if I can jump in, I'm the private markets voice at this table. Which is typically a lot harder for most investors who aren't, ultra high net worth or, institutional investments to invest in, clean tech venture funds or, private equity funds that are focused on sustainable food or focused on, clean energy infrastructure. I think, part of CoPower's mission was to make those types of investments more accessible. And so we launched with the bond product, which is, a very simple, good risk return, product for a lot of investors, not on the super sexy equity side. But I'll give a little secret plug in that we are actually in the process of launching an equity fund, which will be, again, focused on real clean energy assets, a private fund structure. And we'll be announcing that later this year. And it should be accessible to retail investors by mid to late 2019. So we're working on increasing the suite of product options that are actually available to, a lot of Canadians.
Great. And Patty, did you have something to add to that question?
Sure. I just, kind of a word of caution is to make sure that you're diversified too, not put all of your investments into the technology sector. Just make sure that you have a good breadth within your portfolio and monitor it. Don't get greedy.
Can I add? Because I just want to, Patty, that is so important. Thank you. And I think it's so important that the language I use is that most of your portfolio should be what I call doing less evil, where sort of the socially responsible, getting rid of the stuff you don't want, and then really only part of it should be this sort of doing more good. I've met so many people that have just been absolutely burned, have lost their shirts, investing in things like solar panels, which, when China came in, they flooded the market and the solar panels got a lot cheaper, which is great unless you were an investor. Or, a company that comes up a lot is Ballard. They did sort of hydrogen fuel cells. And, it was a bet on a very specific energy, and it just hasn't panned out in the way that a lot of people were expecting. And I know so many people that kind of went all in on those types of green investments and really lost a lot of money. So I would strongly really echo Patty's notion that, diversification is a huge part of it. And by all means, I want people to do these types of green investments, but just make sure that you're not betting on specific technologies, that you are diversified there. And then as part of a greater portfolio where you do have bonds, you might have some private placements, you might have some real estate. So, if you own a property, that might let you take a little more risk with your stocks. But, people really want to have that nice balanced approach.
Question from Rob on this kind of topic. Is there an organization with a website that grades companies through an ethical or environmental lens so that we can evaluate companies? And so first off, thanks to Grant, who also said there's a good research site that he likes called investgreen.ca. I haven't personally heard that, but do you guys have any other resources or sites that are good to evaluate?
Yeah, the one that I like to use is Yahoo Finance, which I know it's Yahoo, who would have thought? But Yahoo Finance has a partnership with Sustainalytics, which Michael Jancy, who created Jancy Social Index, he's come up a couple times, they merge with Sustainalytics. And so I can go on Yahoo Finance and look up a company and click on the sustainability tab, and that'll give me that ESG score, environmental, social, and governance score. It also has a little column on the right-hand side that gives product involvement areas. So you can see whether they do things like animal testing, GMOs, palm oil. They have a whole bunch of different ethical screens there. But that's the resource that I use predominantly.
Can I do a shameless plug for your blog?
Sure.
Another good place to go and look, and not maybe on specific stocks or companies, but Tim, you mentioned in his bio, has a site and writes a blog called The Sustainable Economist. And I've been really interested when I get blog posts that look at specific ETFs or mutual funds, and he actually, in a very clear and simple way, looks into what's in them, how are they doing, how would they compare to other products, and just in a very accessible way that cuts out a lot of the challenging research that I might not do on my own, but I'll take Tim's word for it.
Thanks, Trish.
That's great. Patty, you have something to add?
Sure, there's a few other sources. One that does cost money, it's MSCI, so that's Morgan Stanley, and Corporate Knights also runs different lists, the top 100 companies, best employer, that type of thing. So depending what you're screening for, there's a number of different sources. And go to the company's websites. Their sustainability reports are amazing. I read them, and they can be up to a couple hundred pages, so don't go into depth, but there's usually an executive summary, and it's actually a really good way to learn about a company, what their practices are.
That's great. Thanks, everybody. Greg, is there another question?
Yeah, this is a good one, and I think it brings up a broader topic about TFSAs, what they are and their use. And so the question is about asking, am I right to be concerned about the impact of a simple savings account at a regular bank? Are there options in Canada to have our savings money sitting in an account without contributing to environmentally devastating projects? Which first leads to me about, let's talk about TFSAs and what can go into TFSAs and the misnomer of a tax-free savings account. Who wants to start with that?
Patty, do you want to go, or shall I?
Sure. Well, tax-free savings accounts allow you to save, and any interest or capital gains, dividends, whatever, are not taxable until, and even when you remove the funds from the tax-free account, they're not taxable again. And you have a choice of where that's invested. So it doesn't have to sit in a savings account. You can choose how those investments are allocated. And if you're really worried about a bank, you can look at a credit union. Credit unions give back to the community, and they're quite transparent. So, you do have options where to have your money.
Thanks, Patty.
Yeah, and I'll just add, so TFSA, I think, often makes a lot of sense for people who are just starting out, who still have a relatively low income. If you've got a low income, you're not paying a huge tax rate, then that RSP sort of rebate that you get just isn't as valuable. And so for that reason, TFSA can be a lot better because it is more flexible. Patty mentioned that you can take money out without penalty. So if you're an entrepreneur and you might need this money later on, or like there are a million reasons why you might need to access your cash before retirement, that's where TFSA makes more sense. Where as soon as you start earning, if your income is higher and you're in a high tax bracket, that's where that RSP rebate is really, really nice, right? And that's when people certainly ought to be sort of maxing out their RSP first to get that tax rebate. And then to Patty's comment about credit unions, I mean, that's a great way if you do just want, a checking account, savings account. Credit unions are owned by the local members. So really, you tend to be supporting loans, things like mortgages or small business loans within your own personal community. And I do have a couple blogs that I wrote just because I got that a lot. And so the first one was how to fire your bank, which people loved. And then I got a lot of pushback saying, well, banks aren't that bad and there's some good banks. And so to put that to rest, I wrote a blog post called 3 Reasons Why Credit Unions Are Awesome. So it just kind of goes through why, it is sort of a way to contribute to your local economy. But those are resources that I put up for free.
And I think just for greater clarity, like your registered account, your TFSA, your RSP, don't have to be, obviously they can be with a credit union, they can be with a bank, they don't have to be with either. I think, a lot of people they have a bank account at whatever bank, and then they get notifications saying open your RSP or contribute to your TFSA. You have other options. So I know a lot of Tim's clients are with Questrade, a discount brokerage where you can do it yourself with lots of different types of investments. That's where a lot of our clients are too, that hold bonds in their RSPs and TFSAs. You can go to an advisor like Patty and open it up at Raymond James and choose your investment options. So just because the bank's trying to sell you a registered account doesn't mean you need to buy it there.
And for TFSA, does that mean I have to have a savings account for the money in my TFSA?
No.
What else can go in a TFSA?
Anything can go in a TFSA. You can have stocks, you can have bonds, you can have ETFs, you can have mutual funds, you can have co-power bonds, so private placements. The way I like to think of an RSP or TFSA is like a vault, right? So you'll have the vault sort of at your bank or at your credit union or at Questrade or at a brokerage. And then from there, you can hold whatever you want inside that vault. So you can hold cash, but you can also hold all these different types of investments. And anything that's inside that vault grows tax-free, which is phenomenal. And the government really only cares about money into the vault and money out of the vault. That anything that happens inside that vault, they don't really care about. So, when my investments grow inside my TFSA, I don't even get a tax slip for that. I'm paying no taxes on any of those gains, which for me is great. So, I do know a lot of people who use it as just for a savings account, and that's fine. If you have lots of room in your TFSA, by all means, keep your cash in there for your emergency fund. That said, if you've got your TFSA maxed out and you still have cash in there, then it's probably a little bit of a waste because that is money that you could be earning a higher rate of return. And obviously that would be a tax-free return.
Thanks, guys. Greg, is there another question we want to ask the panelists?
Oh, yeah, I'll keep going. Everyone's really active. This is awesome. On the fee concept, another question. I've got money invested with NEI and would like to hear recommendations on lower fee investing.
So I've got ideas. Patty, do you have any thoughts first?
No, I'll let you, Tim, because you do more of the
Sure. The low fee stuff. So yeah, I'm on a bit of a mission to help Canadians lower their fees. And so there are a couple different options. One thing that's really weird about mutual funds, I don't want to go too deep into it, but there are different series of mutual funds that are available. And so oftentimes what I'll help people do is if you're sold a mutual fund through a dealer, they're going to sell you what's called the A series. And included in that A series fee is a fee that goes to the salesperson. Now, if they're a good person, if they're a good planner and they hold your hand and they're responsive and they help you out with financial planning and other things, oh my goodness, so worth paying that fee. But I've met a lot of people who walk into the bank, they buy the A series version of the fund from a salesperson and then never hear from that salesperson ever again. And that person is getting about 1% of your money every year. as long as you're invested in that fund. So instead of that, what you could do is you could open up an online broker. I do like Questrade, although there are a whole bunch of them and all the banks have them. So like TD has WebBroker, RBC has Direct Investing, Scotia has iTrade. And you can often buy what's called the F series, the letter F as in Frank. And so you could buy the F series version of that NEI fund, which would strip out that, usually it's about 1% trailing commission, and you could own the same exact fund at a much lower fee. Option number 2 is to ditch the mutual fund and to move towards ETFs. Now, obviously that requires a little bit more work. You need to understand what ETFs are appropriate. Oftentimes, a lot of these sustainability ETFs are in US dollars, which means you need to convert your money. So there's an extra step there. And, there are ways that we can, avoid fees and do it in a very cost-effective way. But it is a little bit more complicated. And so that's really my business model as sort of an investment coach, that this is where, I save my clients a huge amount of money, is getting them out of those higher fee mutual funds and into some of these lower cost ETFs. It's really an educational thing. So it's like you're paying me by the hour for the education to learn about these things and how to do it. Once you're able to do it on your own, then it's like, okay, you don't need me anymore. And, most people feel comfortable managing it on their own. But I totally get that that's a little bit of a scarier approach. But it's one of those things where if you do want to lower your fees as much as possible, there is going to be some education involved there.
And I think we have time for another question or so. Greg, is there another question you want to ask?
Keep the time's going. First one on bare basics. I want to know the fundamentals of investing. Like, what are guides, book recommendation? I'm talking very beginner, like teaching a child from the ground up, except it's for an adult who's just never spent enough time educating herself. What's the go-to resource? What would you suggest?
I don't think you can go wrong in Canada starting with The Wealthy Barber. That is more of a bigger picture, budgeting, cash flow, stuff like that. They do touch on investments a little bit, but I would say for me, that is kind of very much the default place. I'm trying to think of some of the simplest ones. I know Ellen Roseman wrote an Investing 101. I forget the title off the top of my head. But if you look up Ellen Roseman's book, I know she's got a very, very sort of simple starter. And I know there is like literally, Investing for Dummies is a thing that does exist. That series has done quite well. Patty, what are the resources you point people towards?
Well, there's an online course with the Canadian Securities Institute, so the CSI. It's a little bit more in depth, and it might be more than the person's looking at. A lot of universities have continuing ed courses. I know the University of Calgary has an introductory level and a level 2. Even finding an advisor that will walk you through and explain is a really good approach too. I spend a lot of time educating my clients. They have to understand what they're invested in before I will invest it. So before I take it money, I guess. Yeah, that's great.
And Christine, something that I've been getting more familiar with is a lot of bloggers and financial personalities online. They do a very good job of breaking down basic concepts. And one that actually just launched basic investing geared towards females in particular is Jessica Moorhouse. And she just created an online course to get people from the very basement understanding all the concepts, ask all the stupid questions. Yeah. She's pretty great, and I'll include all of these links that I've been typing down in the follow-up email, so just let everyone know.
On that note, I'll just add Reddit has a really, really good Personal Finance Canada subreddit where you can just post a question there. And obviously it's strangers from the internet, so take it with a grain of salt, but I'm really, really impressed by the information on Reddit.
Yeah, and I was gonna say bloggers too, but I also think make sure you're checking out what's happening in your local community, because often some of these personal finance bloggers or other groups, associations might have personal finance workshops in Calgary or wherever you are. I know that there's a group called Women Investing for the Sustainable Economy that has chapters in different places. They just held one of those here in Toronto, which is great. So definitely lots of places to go. We've probably overwhelmed you now, but Greg will send the list.
And then Trish, a couple questions about bonds. One from Calvin about CoPower. Do we need to be a sophisticated investor before we can participate in the CoPower green bonds?
Mm-hmm. So there might be two different ways you're thinking about sophisticated investor. So one, sometimes what's in Canada legally called an accredited investor is also referred to as a sophisticated investor. And that means you have a certain amount of wealth or a certain income that qualifies you to make lots of different types of investors.
If you're a millionaire.
Basically you're a millionaire. And then there's obviously the definition of sophisticated, which you know a lot about in investing. And the answer to both questions is no. We obviously so CoPower bonds are available to investors across Canada at a $5,000 minimum. So you do have to, to Tim's point, you probably have to be up in that kind of probably $15,000 range before it makes sense to put $5,000 in CoPower green bonds, because as an alternative, we're likely a piece of your portfolio, not the whole thing. But they are accessible, and in terms of investment knowledge, no, our investors, have a breadth of investment experience from very little to a lot. Part of our responsibility is to do a know your client and suitability assessment to make sure that the investment makes sense for you based on your risk tolerance, your income, and a whole bunch of other factors. And we'll walk you through the details of what exactly is the product. We pride ourselves on transparency, so all of our CoPower investors can see exactly the projects, the clean energy projects across Canada they're investing in, so they can understand how they're creating value, how they're reducing carbon, all of those pieces. Our team here, our platform is very self-serve. You can find a lot of information, but every investor has a call with one of our investor representatives here, both to make sure we've done that suitability assessment and can ensure that the investment's right for you, and then also to make sure we're answering all your questions and that you totally understand exactly what you're investing in.
And then what about cooperatives? So like solar co-ops, like how difficult or easy is it to invest in cooperative?
Yeah, so when it comes to co-ops, oftentimes this will be in the realm of sort of impact investments, where it will be community bonds or solar bonds, that type of thing. Very, very similar process to what Trish described. Oftentimes there is a little bit of paperwork that you need to do, and you do need to be careful if the goal is to get it inside a TFSA or an RSP. There can be some fees there, so it might make sense to kind of ask the question and make sure that the fees don't outweigh the tax savings.
Always ask about fees.
Always ask about fees. But really, it does tend to be really quite straightforward. I've participated in a couple different those offerings, and it's really just like a form, and then write them a check or do like an electronic funds transfer, and you just kind of link it with your bank account, and then I've just received the interest. So it's pretty straightforward. There's a little bit of paperwork involved, but hopefully, again, like CoPower, they've got good customer service where they'll walk you through the process and hold your hand and answer your questions as you go.
There's a question about Qtrade, Qtrade connected to credit unions, Qtrade versus Questrade. Why would you use Questrade or Qtrade?
So the language is tricky. Qtrade and Questrade are two different online broker platforms. I know they sound so similar. Qtrade, it's a little bit funny. I need to see, because there was just a bit of an amalgamation, and this was, I believe, like Northwest Ethical and all these firms. And I see you nodding, Patty, so you might know more about this than I do. But
it's now under the Aviso.
It's called Aviso, is the new company, which my understanding is that it's owned half by sort of the Desjardins and the other half by the rest of the nation's credit unions, which is great that it has that relationship. Questrade is totally different. It's a private company. They kind of are considered an independent broker. The difference really is going to be this trade-off between fees and customer service, is how I would say it. They're both really, really good options for do-it-yourself investors. Questrade tends to have lower fees. So they let us buy ETFs for free. We've got a path to get CoPower bonds and these other community bonds inside an RSP or a TFSA. They'll sort of waive the quarterly fees if you've got at least 15K invested, so which goes a long way there. That said, they're independent. They're probably a smaller firm. Their customer service is okay. but not as good as Qtrade.
It's much more do-it-yourself.
It's much more do-it-yourself, absolutely. Qtrade, I find their customer service is like phenomenal, where you call and it's within 2 or 3 minutes I've got a human on the phone. That said, it's
but
like
you can't do private placements.
You can't do private placements.
So you can't hold community bonds or CoPower bonds or any other private investments, whereas you can through Questrade, which if you don't want to go private, it doesn't matter. But some of our clients are a bit frustrated when they come to us and they realize their account's somewhere, and if they'd opened it up somewhere else, they'd have more optionality. So just something to be aware of.
So typically what I do with clients is we actually come up with your portfolio first. We make these investment decisions first. And then what we can do is look at the cost structures of the different brokers, figure out, just so that you have the transparency and you know sort of what that financial trade-off is going to be. If it's something like CoPower, then it becomes a bit of a deal breaker oftentimes. But really want to communicate. They're both good platforms. They do basically the same things, just with slight differences. And I will say that MoneySense, which is a great resource, moneysense.ca, and they do every year a list, a ranking of online brokers so that you can see. I don't think the private placement stuff gets in that profile, but maybe we could ask them to include that. But for people that are kind of, again, with all this stuff, ask questions around fees, shop around, figure out the platform that's going to be best for you.
And now we're just over the 3 o'clock mark. So I think like a last kind of statement from each around like what advice do you have, or what's like the sign off thought for these people? Thank you all for being on the time with us. Sure. What's your last parting thoughts, Trish?
Well, I think it's fantastic that, all of you are interested in thinking about, obviously EcoTrust graciously hosted this webinar. So I'm guessing we have people who are very environmentally conscious on the line here. And I think congratulations for taking the step to think beyond, what you do or what you buy and start thinking about what you own, which is your investment portfolios. So awesome first step. And I think we're all kind of here to help more people through this journey. So keep in touch.
I think for me, it's really, there's the old analogy, the best time to plant a tree was 30 years ago. The second best time to plant a tree is today. And it's the same thing when it comes to investing. This is a long term. We're talking about decades here. It's really easy to get caught up in the short term noise in the markets and, what did Donald Trump tweet today? And I think that a lot of people get stuck and they just end up doing nothing. And I've met a lot of people that just stayed in cash for years and years, and in some cases decades and decades, because things weren't perfect or they didn't fully understand or didn't totally 100% line up with their values. And so for me, it's kind of back to a point Trish made earlier, which is just like get started and just try it and get the support that you need and do it. But really it's about sort of taking that first step. And the best time to invest would have been 30 years ago, right? The market's done well over that period, but the second best time to invest is today. And so really getting people over whatever psychological barriers, technological barriers, doing the paperwork, just whatever you need to do just to actually get your money invested so that it can start to compound over time.
Patty?
And I very much what's been said, just make sure that you set your goals, understand what your values are, align your investments to your values. You can start really simple. Most people have RSPs set up through work. Ask at work if you have a choice of responsible investing through your pension, and start. You could start simply there and move your way up. But do ask questions, get started. Good luck.
Yeah, thanks everybody, and I want to just echo Greg's thanks. Thank you so much for tuning in, and thank you, Patty and Trish and Tim. I've certainly learned a lot today, and I'm sure everyone else who was listening in did as well. And so, just a reminder, this has been recorded, so you're gonna get this. And Greg's been collecting all those resources that he'll send out. So there he is, confirmed. So thank you again, everyone, for being here, and happy Valentine's Day and happy investing. Thanks.